Okay, so Argan just posted this unbelievable 25% gross margin building complex power plants, but they didn't do it with some magical pricing trick. They literally just finished a mega project and went home 2 months early.
Right, because time is literally money in heavy construction. If you aren't paying daily site burn rates for 60 extra days, that drops straight to the bottom line.
It is amazing. Welcome to Earnings Unscripted. It's March 26th, 2026, and we're unpacking Argan's fourth quarter results, ticker AGX. And very quick disclaimer, this is all just our personal opinion, absolutely not financial advice. So please don't buy an industrial gas turbine based on our podcast.
Or do if you have a really big backyard. But honestly, Argan is exactly the reality check the market needs right now. While everyone is fighting over software and GPUs, these guys are out there mixing concrete and standing up actual power plants. The AI grid needs electricity, and Argan is the shovel-in-the-ground reality of that.
Exactly, and the numbers completely back it up. Revenue hit $262.1 million, and earnings per share came in at $3.47. That is massively up from $2.17 last quarter.
And the profitability jump is what caught everyone off guard, going from an 18.7% consolidated margin up to 25%. Their core power segment actually hit 29%. In the EPC world, engineering and construction, you just don't see 29% margins unless you pull off a logistical miracle like they did here.
Which the daytime trading session completely missed, by the way, because they were selling the stock off all day. It dropped down to around 410.
Yeah, the regular tape was awful, but the second those after-hours numbers hit, it was instant regret for the shorts. The stock just gapped up immediately, surging right toward 450 before management even got on the earnings call.
Up almost 10% post-market. It's funny how fast the narrative shifts when people suddenly remember data centers actually need to plug into something.
That's the whole thesis right there. They have a $2.9 billion project backlog, and it's roughly 77% natural gas. So despite all the headlines about the renewable transition, natural gas is still what you actually need to keep a data center running at 2 in the morning.
Right. It's the bridge between what sounds good on paper and what keeps the lights on. All right, let's get into the details and unpack how sustainable that margin really is.
Yeah, well, the short answer is it's probably not sustainable. Management definitely tapped the brakes on that. The CFO basically said it is too early to give a 2027 margin outlook because, Trumbull was a specific one-off efficiency victory.
Right. You can only pack up your tools and go home early so many times.
Exactly. The execution was flawless, but it is not a structural pricing shift. But what is structural, and honestly pretty wild for an engineering and construction company, is their balance sheet. I was looking at their cash and investments, $895 million. Zero debt.
Wait, almost $1 billion in cash with no debt? In heavy construction?
Yes. It acts like this massive economic moat. It lets them underwrite enormous project bonds without breaking a sweat. But what really jumped out to me is that it just generated $7.7 million in net other income this quarter alone. They are making real money just sitting on the cash pile.
That is, wow, it is almost like a side hustle, just clipping interest coupons while pouring concrete.
It is a great feedback loop. Good execution funds the treasury generates yield pads the earnings. But here's the thing that I think the market is slowly waking up to. It's not just about natural gas plants feeding the public grid anymore. The CEO noted a new contract in their industrial segment, a $125 million award explicitly tied to the data center market.
Okay, hold on. Direct data center involvement? Because we usually talk about them building a turbine miles away from the actual server farm.
Right, but the line is blurring. They are starting to field inquiries for behind-the-meter projects, basically private mini-grids for heavy energy users who cannot rely on public utilities. On the call, the CEO, David Watson, he actually framed the macro problem perfectly. He said, and I wrote this down, decades of underinvestment in energy infrastructure has created a critical imbalance between the high demand for energy and the constrained capabilities of the power grid.
Which is the polite corporate way of saying the public grid is tapped out and tech giants are starting to panic.
Pretty much. If you are building a gigawatt AI cluster, you cannot hope the local utility finds the capacity in 3 years. You have to build the generation right there on site. And Argan is telling the market, hey, we are the guys who can build that private baseload plant for you.
I mean, it makes total sense. But it also sounds like a massive bottleneck if every single cloud provider suddenly wants their own private power plant. How much can Argan actually take on? What is their operational speed limit?
That is the ultimate constraint. It is not demand. It is their own operational bandwidth. Watson was very transparent here. He said it comes down to project capacity. Structurally, they can handle maybe 10 to 12 major jobs at one time. Right now, they have 9 underway.
Oh, okay. So they are practically at full capacity. 9 out of 12.
Let me rephrase that slightly. 9 active means they have room to squeeze in 2 or maybe 3 more massive contracts over the next year before they hit the red line. They are running a tight ship. They are not scaling up to 20 concurrent jobs just to chase headlines.
Capital discipline, or labor discipline, I guess. It's probably impossible to find enough specialized engineers to run 20 gas plant sites anyway.
No, exactly. And that scarcity is giving them leverage. They noted their pricing model remains exactly the same as always because, quoting them directly, there is enough work for everyone right now. They don't have to undercut competitors to win bids.
Right, which goes right back to the physical reality of all this. You can print infinite lines of code, but you cannot print a steam turbine or the skilled labor to weld it.
You can't. And that is why they are so hyper-focused on site execution. If you slip up on one of those 9 active sites, the daily material and labor costs just eat your margins alive. Time is the only thing they're really fighting.
Okay, so they have this pristine balance sheet, a strict capacity limit of roughly a dozen projects, and a brand new back door into direct data center builds. It feels like they're holding all the right cards right now. So where does this leave them heading into next quarter?
Management is notoriously allergic to giving exact numerical guidance just because of how lumpy heavy construction is. But looking ahead to 2027, they explicitly expect to add a handful of jobs over the next 8 to 20 months. So the baseline demand is absolutely there.
Right, which is great. But are we primarily relying on these private data center builds to fill that remaining capacity?
Well, there is actually a broader public wildcard on the horizon. I mean, we saw what the Texas Energy Fund did down south. It basically supercharged the natural gas pipeline for them in Texas. Now, management is closely eyeing the PJM region. That is the massive eastern transmission grid. They have emergency capacity auctions coming up that could act as the exact same kind of regulatory rocket fuel.
Okay, yes, but let's be real for a second. What actually breaks this thesis? Because if they are already running 9 out of 12 possible projects, and they need these giant industrial parts, you can't exactly order a gas turbine on overnight delivery.
No, exactly. That is the real vulnerability here. It is just supply chain. The CEO lightly warned that global manufacturing is still trying to catch up. So if a supplier is 6 months late on a turbine, well, Argan's entire timeline just stalls. They are somewhat at the mercy of their heavy equipment vendors.
It is honestly so poetic. You have all these tech founders preaching about infinite AI superintelligence, and the whole grand vision is completely tethered to whether a traditional factory can forge a piece of metal fast enough.
Yeah. I mean, the AI revolution is entirely dependent on mixing concrete and burning gas. It makes a company like Argan the ultimate physical reality check on the whole software cycle.
The physical reality check. I think that is the perfect place to leave it. We will definitely be watching those Eastern Grid auctions next quarter. Thanks for joining us today on Earnings Unscripted, everyone.
Thanks for listening. We will see you next time.
And if you want these earnings drops to just show up automatically for you, feel free to follow the show on your favorite podcast app. As a quick transparency note, we are an AI-generated podcast, which means our voices are completely synthesized, but all the financial data is pulled straight from real company filings. We always love hearing what tickers you want us to dig into next, so drop us an email at earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out.
Talk to you soon.